One of the most prevalent questions that homeowners have asked in recent times is whether it makes more financial sense to pay down their mortgages or invest the same funds. As a finance professional with over a decade of experience, I've encountered this question several times, and I typically give one statement response before closely analyzing the individual's personal circumstances. And the statement is simply, the right or best decision for you to take would depend on your current or personal financial status. In this video, I'll be showing you a clear analysis to help you determine whether to allocate your spare funds towards paying down your mortgage or investing in various products such as the stocks, real estate, ETFs, or even a side hustle, and much more. Hey everyone, this is Ebuka and this is the Finance Wiz channel. If this is your first time in this channel, feel free to like, share and subscribe if you find this video valuable, and of course if you don't want to miss my subsequent videos. The Finance Wiz channel majorly focuses on topics around income generation, savings and investments, debt management, and overall financial freedom for you. Now let's get into all I have to say today. So before I start, I want to explain a few terms that will help you understand this concept even better. The first is what I call mortgage. So a mortgage is simply a financial agreement that allows you as an individual to purchase real estate such as land or properties. So in this financial arrangement, the lender actually avails you funds for you to make this purchase, and you as the borrower on the other hand will have to commit to repaying those funds over a period of time, say 15, 20 or 30 years or even more. These payments are typically split into principal and interest, and the property itself is used as the collateral for the funds that are given to you. You also need to know that this agreement gives the lender the right to take over the property if you are unable to make those payments as agreed. So there are different types of mortgage. We have the fixed rate mortgage. In this case, the borrower's monthly payment and interest remains the same throughout the term of the loan. Secondly, we have the variable rate mortgage. In this case, the interest rate is fixed for a short period of time, after which it becomes variable or it fluctuates in line with interest rates. The third is the interest-only mortgage, which allows you to pay only interest throughout the lifespan of the mortgage, and at the end of the mortgage, you'll be required to make a balloon payment equivalent to the principal or outstanding sum as at that day. Now, it's important for you to understand what drives the mortgage rates which is available to you. Now, it's very simple. Think of mortgage as a simple product. Now, when you sell a product, you want to actually add a margin or profit on the product. So before lenders are able to avail you funds, they will typically add some profit to the cost of funds given to you. In order for a lender who avails you funds to make money, they typically have to charge a premium on whatever cost of borrowing that funds would be. Now, the premium that is being charged to you as interest will become the profit of the financial institution lending you the funds. Now, the cost of funds are driven by several factors. Number one is the interest rate from the sources which they are getting the funds from, which is the cost to the financial institution. The second thing is economic growth. So economic growth will typically lead to higher interest rates. Now, when the economy is experiencing a strong growth, there is lower unemployment, and more companies typically want to borrow funds just to expand their business even further. This is because of the increased demand for their products or services. So a mortgage provider would have to pay more interest in order to get investors to invest in their business. The third factor is the Bank of Canada's influence on the rates. Now, when the economy is getting much stronger, the inflation rate tends to rise. Now, in order to keep the inflation rate within check or within a target percentage, the Bank of Canada will typically adjust the monetary policy rate to ensure that inflation rate falls within that target span. The fourth factor that also affects your mortgage interest rate will be your credit history and the features of the mortgage which you are going to choose or go for. The next is what I call the prepayment risk. Now, you need to understand that lenders will typically lose more money if you were to repay all your mortgage loans. So this simply implies that the lender may not make as much money or profit from that funds that they have borrowed from any source they have chosen. That's why you notice that open mortgages, which allows you to pay off all your loans and your mortgage loans early, will typically be more expensive than a closed mortgage that sets a limit on the amount you can pay on an annual basis. So the last driver that impacts or determines your mortgage interest rate is the repayment period of your loan. So you need to understand that the longer the loan period, the higher the risk the lender is going to face. That's the risk of default. As such, they have to charge you something more in order to cover up for those exposures. Now let's take a deep dive into investment on the other hand. Simply put, investment is when you buy an asset at a lower price and sell at a higher price. In other words, you're looking for capital gains and appreciation of whatever product you are investing into. Now, investment doesn't always have to be focused on capital appreciation or growth in the long term. You have the opportunity to buy and hold certain stocks or assets to generate income over a period of time on a passive income basis. So there are different types of investment. We have the stocks, we have bonds, we have commodities, we have real estate, we have index funds such as ETF and mutual funds, and many more. So let's talk about the drivers that impact investment rate changes. The first is what I term the risk and diversification. So the higher the risk you take, the higher the probability that your returns will grow even faster. The other thing that impacts your investment returns is the risk appetite you have. So risk appetite simply implies the maximum risk you are willing to take as an individual. The third and most important condition is what I call macroeconomic factors. So macroeconomic factors like inflation, interest rates, and so on can actually impact your investment returns and the rates overall. So now that you understand the concept of mortgage and investment, including how it works, let's dive deep into the analytics of both ends of the continuum. So in order to help you make your decision even better and faster, I want you to consider these factors before you decide. So the first factor you need to consider before you decide whether to pay down your mortgage or invest is how high your mortgage interest rate is. So if you watch my previous videos where I talked about debt elimination, I talked about the avalanche method of paying debt, which significantly focuses on paying the high interest debt down to the lowest interest debt. If you missed that video, I've tagged it here so you can go watch it. So you may actually want to consider paying down your mortgage if the interests are significantly high, say 5 to 7% and above. Conversely, if your mortgage rates are typically low, say 5% and below, you might want to consider investing instead. Now you need to remember that credit cards and other personal loans which have higher interest would need to be prioritized above the mortgage because of their high interest rates. The second factor you need to consider is your closeness to retirement, or how close are you to retirement. So as you get closer to retirement, it's absolutely normal for your risk appetite to significantly reduce. Retirees, or those tending towards retirement, tend to want to pay off or pay down all their mortgages because they likely will not be expecting any earned employment income going forward. Due to this risk-averse perspective, it will be recommended for you to avoid investments that exposes you to variability in your returns or your investments. This is because at this point you are likely more focused on saving towards retirement. Conclusively, I'll tell you to assess how conservative you are as an individual to decide on what direction to go towards. The third factor is what I call financial circumstances. I've noticed from my many years of financial experience that due to the eagerness to pay down debts or mortgage loans, so many people dip hands into their savings without recourse to their current financial situations. I've actually seen individuals that make extra payments without having any emergency funds set aside or liquid assets or funds to take care of their day-to-day expenses. This is something you need to be wary of. If you don't take this factor into consideration, you'll find out that most of your funds will be tied in your home, which means that if there's any emergency, you'll be unable to meet up, or even if you choose to meet up, you'll be forced to go for a new personal loan or a line of credit. This in itself will eliminate the gains or the profit you get from paying down your mortgage. The fourth factor is what I call the risk attitude. How much ease do you feel when it comes to taking risk as a whole? Now, paying down your mortgage is simply very conventional and secure and even safe. With mortgage payments, there's clear predictability. You know how much you're paying and you know how much you're saving, clearly put. But in terms of investment or returns, it comes with a lot of fluctuations and the risk of uncertainty overall. The fifth factor is what I call closeness to the end of the mortgage. As you're already aware, at the beginning of your mortgage, most of the mortgage payments that you make will go towards your interest rather than your principal. This in itself makes homeowners to be more aggressive towards their home payments at the early part of the mortgage. This is because extra payments at the early part of the mortgage will reduce the interest payment over the lifespan of the loan. However, if you are far gone into the payment of your mortgage, you likely will be paying more into the principal rather than the interest, which automatically frees up some more funds for investment. So this might be something you need to consider. The last factor is what I call emotions and psychological effects. I know some people are just not comfortable with the idea of having debt as a whole going into retirement. As such, they do everything possible to make payments into the mortgage to reduce the loans or indebtedness overall. However, I recommend that you do proper analysis before you make such decisions and not act based on just emotions alone. So I'd recommend that you either do it yourself or consult a financial advisor that can guide you through the process of analyzing these two factors. So I'll be showing you a simple illustration that can reflect how you can do this analysis on your own if you choose to. Now, if you can see my screen and you see this illustration, let's assume that the mortgage of this individual is $135,000 outstanding on the 25-year 5.25% fixed rate mortgage, and you choose to pay an extra $100 per month, which means that your monthly amount will move from $809.99 to about $909.99 as an example. Now, the result is that if you put that extra $100 per month, your mortgage term will reduce by over 5 years, which is amazing, right? Now, you make a savings of about $25,000 interest over the mortgage lifespan. Now, let's look at the investment perspective to see how that will play out. Now, this is the investment perspective. Of course, we've agreed that $100 is the additional amount the individual wants to pay. Assuming you are investing $100 on a monthly basis over the remaining span of 20 years, in an average stock or ETF with returns of about 10%, and of course I wrote just be conservative because certain ETFs can give you as much as 13%. Now, the results would be an investment value at averagely $56,801. Now, let's compare both ends to see how it plays out. Now, from a cost-benefit analysis, it's clear that in this situation, you will make a gain of more than $25,000 from investing alone. In this case, it's a no-brainer. Investment should be a better decision. So you need to do that analysis on both ends and determine if one is worth more than the other. Now, a very important thing for you to note as someone that is making an extra payment, you need to make it clear to your financial institution if your aim or focus is to reduce your monthly payment. Unfortunately, my financial institution did not offer me this privilege. Alternatively, you can also establish that you want to reduce your mortgage term or tenor. Now, I just want to summarize it with an upside of why you should pay down your mortgage. One advantage is that extra payments allows you to reduce your interest over time. You create more equity even faster, which allows you to access home equity line of credit, and more money is freed up for other needs such as investments. On the other hand, the downsides of paying down your mortgage is less liquidity, number one. You could get penalized for prepaying in advance or increasing your frequency of payments. Then the last one is the less risk diversification due to focus on just real estate alone rather than other investment sources or products out there. Now, there are several benefits of investment. Number one is the increased potential for higher returns as a result of compounding interest on your investments. As you're very much aware, the stock market has over time outperformed the housing market in the long run. The second one is your increased liquidity to handle or attend to emergencies as they arise. The third is that you can take advantage of tax-registered accounts such as TFSA and RRSP. In other words, your investment can grow tax-free over time. The last is what I call your organization's group retirement benefits. Now, if you work in an organization that matches your own contribution, this might be a good source of raising or investing funds over time. Now, in this case, rather than putting the money or paying down your mortgage, you could invest that money into such group retirement benefit plan and be rest assured that your employer would match those funds. This is a fast way to grow your investment. The only downside of investment which I can think of is just the variability of return, which is typical to any market, whether the stock or real estate market. It is completely inevitable. Now, to conclude all of these things I've said, I've seen several action plans that have worked and which you could consider as well. You could choose to switch to an accelerated bi-weekly payment for your mortgages. You can simply pay an extra sum, maybe a third of what your monthly amount is, to your mortgage, or you can simply split your savings or whatever spare funds you realize from your budget analysis into the paying down of your mortgage or to your investment portfolio. Alright, that's all my analysis, and I hope you gained a lot of value from this video. I'm actually curious to know what decision you end up taking. Please drop your comments in the box telling me what decision you ended up taking and what factors you consider. Also tell me if there are other factors which you consider that are not on my list I've explained today. Thank you and have a good one. Bye.